Gurmeet Chadha joins us on the show now. Gurmeet, wanted to begin by discussing the IT pack with you. If you purely go by the commentary or the earnings of Q3, there was nothing to get the street excited. But I don't know if this is a case that a bottom has been made and finally the street is believing that.
Yeah, I think bit of value hunting and also the fact that the markets are forward looking. They probably believe that the worst in terms of IT is probably behind it. So there's some rub off, with the movement in Nasdaq also with the big tech moving. But I still think valuations are now stretched. There was a lot of value when you were getting Infosys at 1200, Tech Mahindra, HCL at 1000 odd, at 12, 13 times earnings, Infosys at 16 times. But now the valuations are more towards higher side, which is around 25, 30 times in most names, barring maybe HCL Tech. Still, I think with the kind of guidance, it's still a little more reasonable. Even in mid cap IT, you're paying a very high multiple for good names like Persistent or Cyient or even KPIT. So I think a lot of valuation comfort is not there. It was the case. So it's as they say that you should differentiate if the problem is structural or temporary. And I think the problem was temporary in IT, and people who probably were patient have been rewarded. I think rotation will happen. I think similarly now, I think everybody's writing off chemicals, right? Again, the problem in my view is still temporary, but the temporary may last for a few quarters. So I think this sector rotation happening. I don't see much valuation comfort right now.
Gurmeet, hi, afternoon. I know you've been a strong believer and investor in the private banking names. But would you say it's time to value hunt, add more on the current decline and underperformance that one is seeing, or would you say steer clear better opportunities clearly in the market?
No, there are clearly opportunities. I think it's not every time you get leading private banks at two book value and 14 to 16 times earnings. Most of them, right? You pick Axis, HDFC. I think ICICI for the first time is now trading at a higher valuation than HDFC. If you take FY25 core price to book, some of the PSU banks like SBI again a one book value 9 times. Bank of Baroda probably 7 times. So I think there is definitely value. I think, but the key concern is that you probably need 1 quarter of bottoming out of NIMS. So I think the key trigger could be once the rate cut starts, probably maybe closer to H2, which is May, June, in my view. And cost of borrowings also come down as yields fall. For the near term, I think the treasury gains will support any compression in NIM in my view. So I think there's definitely value. Also, see, last 1 year, Nifty is up 20%, Bankex is hardly up 11%. So, in my view, some rotation will happen. Thirdly, non-financials, we are more constructive. I think the way we are adding 25 lakh new investors every month in capital markets. So, the depository, the RTA agents, the AMCs, I think those are, in my view, better play and probably more structural and more asset light vis-a-vis some of the other financials. NBFC and banks, in my view, will possibly have to wait it out till the rate cut starts.
Ask you about Paytm. Although today you've seen some bottom fishing happening, there's been a sizable 1.5% equity which changed hands as well, a block deal earlier today. But would you say wait it out, let the bridge flow under the water and then take a call?
I see anything to do with regulator, especially on compliance. I think right now what you're doing is speculation. It is not investing because you don't know how deep is the concern RBI. As RBI usually doesn't take such stringent actions. Now, if assuming, let's say, if the payment by license goes, it has a huge impact on the other businesses as well, right? So I think we should wait it out because some of the concerns raised in terms of onboarding, in terms of KYC, single PAN being used for multiple accounts raises concerns, on compliance and supervision level. So I think we should wait it out. I think there are better opportunities in the market, and acting when there is regulatory action impending is, as I said earlier, is speculation. So I would avoid till more clarity comes. Yes, of course, it has fallen. It's at all time low. But in these things, you don't know, what the bottom is, especially when it comes to regulatory action.
Okay, but as promised, it is Britannia that the street is expecting numbers for. So let's take it across to Vinny to get a sense of the expectations. Vinny.
So absolutely, in terms of numbers that one could expect from Britannia, muted growth in terms of revenue as well. Only a 2% growth in terms of revenue is what we're expecting. And obviously because of that also volumes are expected to be flattish as well. 0 to 2% is what is the volume growth as one could expect. Now let's not forget factors that are impacting the numbers or the company overall at the FMCG pack is rural slowdown. That's an important one because that's not seen a pickup as well. Other than that, Britannia has been focusing in terms of increasing the distribution through the rural areas, and that is one factor that is furthermore impacting their growth trajectory as well. Competitive intensity, that's been continuing from regional players since inflation is coming down as well. So yes, that's something that could be weighing on the volumes, and obviously while we're seeing grammage increase, that is something that is maybe supporting a bit of the volume growth. So let's keep an eye out on in terms of the volume number. Other than that, when you're looking at it in terms of the margins of the company, expected to see a decline. High base is one of the factors. Other than that, in terms of the higher ad spends, that's something that is impacting the EBITDA margins of the company as well. So yes, all in all, let's watch out for other margins because that is expected to contract by around 100 basis points as well. So key factors to watch out for in terms of commentary, in terms of rural, how is the inflation shaping up in terms of the raw material costs, and adjacency performances are key factors to watch out for.
Right, and Vinny, give us some color on what the urban consumption trend could be. What's Nestle likely to report?
So overall, in terms of the segments that have been doing well in the FMCG pack is the food and beverage segment, and that's where a major part of Nestle's business comes in from as well. So that has been doing well, and that is why Nestle is expected to see a growth of around 9.9 to 10% is what you could say, a double-digit growth, much better than what we have seen for other FMCG companies. Other than that, profit is also expected to see a growth of 16%, margins and expansion of 170 basis points as well. Now overall volume growth, that's expected at around 5% for the company, and like I mentioned, food and beverage overall as a segment is doing quite well during the quarter, and that is what will be supporting the numbers of Nestle in the December quarter. Strong double-digit growth is what we're expecting in the domestic business, mainly driven by chocolates, confectioneries, as well as the nutrition business. They're expecting higher competition is what one could expect in terms of out-of-home consumption for Nestle, and deflation in edible oils, wheat, packaging, as well as dairy prices and operating leverage is something that will be aiding the margins of the company. So yes, let's keep an eye out on commentary in terms of rural demand, in terms of the milk and nutrition segment, and pipeline in terms of new product launches are key factors to watch out for from Nestle.
Okay, point taken. So that's the expectation from Nestle this time around, as well as what to expect from Britannia. But in terms of the market mood, well, actually today we've managed to hold on. There hasn't been that last hour sellout that we were witnessing for the last couple of days. In fact, we're ending close to the highest point of the trading session, 21,940. Last 1.5 minutes left. So let me take it quickly across to Gurmeet for one last question. Gurmeet, on telecom. With the Airtel's earnings, is it a fair case to look at that sector again?
It's already done very well. I think it's now more a 2.5 pair industry. We are seeing ARPUs now above 200. I think one good thing which I liked on the commentary is the capex next year could be slightly lower levels, which means free cash flow generation and some balance sheet improvement. I think Airtel has been prepaying also. So I think it's a great play on the digital infra, almost a duopoly kind of a situation. And with 40 crore plus kind of subscribers, if ARPU goes up another 10% from these levels, you probably will start generating more cash flows and a reduction in debt. So you'll get both operating as well as financial leverage playing out. So it's one of our core portfolio stock, pretty constructive.
We'll let you go. Good to chat with you as always.